Hello and welcome to Livewire Markets. My name is Anna Dadich. As part of the Alternative series, I'm joined by Paul Miron, co-founder of Msquared Capital. He's going to unpack the myths and risks of private credit and where the smartest opportunities lie. Welcome, Paul.
Thank you, Anna.
So how would you describe the current investment environment and where are the biggest disconnects between perception and reality?
I've been in the industry for 30 years and the current environment is not something that I've seen in my working history. So if you walk down Margaret Place at the moment, there's a queue down the whole road to buy physical gold. Now, I've never seen gold at record prices, share market, property, and nearly every single other asset class. So this amount of liquidity that we see in the marketplace, I've never seen before. So this is a quite unique and interesting time. But on the flip side, if you look at businesses, they're not making record profits as well. So 1 out of 5 companies with the recent reporting, they've only matched what they were forecasting. So 4 companies missed their forecasts. Households are not making more money as well. So there are some pockets and places where it's a bit of a concern for us. There's certain pockets of property market, different segments where people are feeling the pinch. It's harder to service those mortgages with increasing cost of living as well. So when you talk about reality and perception, asset prices are going up, but maybe things are not as good as what people think they are.
So private credit has been booming globally.
Yeah.
What's really driving the capital flows into the space, and are investors truly aware of the risks that they're taking on?
Well, there's so much to unpack there. Yes, it's booming. There's no question about it. Private credit is experiencing significant growth. It's growing in excess of 20% per year. Now, if you really unpack it and understand where the demand is coming from, there's always 2 sides of it. The borrowers are looking for alternative forms of finance, and it's not because the banks are too difficult, it's just there are niches in relation to the market where banks don't want to participate, or it takes a bit too long, or people just feel the need to have quicker finance. So that part of the industry is growing, so there's a larger demand from a borrower's perspective. From an investor's perspective, it's all about income. People are looking for income, and they're looking for higher levels of income as well. And that's, there's a demographic issue there, is that you have most of the wealth held by people who are in their 60s, and income is a really important part of their portfolio. And also, there are structural changes in relation to investment. So, there's a lot of concentration risk at the moment in relation to certain companies or ASX and traditional ways of financing. So alternatives are booming, and private markets are booming at the same time.
So you've said that some private credit funds are taking on equity-like risks for debt-like returns. Can you explain that and where you're seeing that play out in the market today?
Well, it's a great catchphrase, isn't it? A lot of fund managers globally have been saying that for a while, and it just seems that it's catched on now. And the logic is there is that, if I'm getting 10% return, why do I need to have the downside risk of the market? And you really need to look at the difference between what private credit is and the rest, like equity. And a lot of people, unfortunately, look at through the same equity lens between 2 asset classes, and they can't be more different. When you're looking at equity, you're looking at upside. You're banking on, hopefully, that share or that portfolio is going to grow. You're really invested into the performance, the upside of that company. When you're doing private credit, it's the opposite. It's the asymmetric risk. So when I look at debt, the number one concern for me, and the first question you ask, if ever it goes pear-shaped, can I recover the capital and interest in every single time from my investors? And that's the biggest difference. And so it's really important for investors to understand the difference. Now look, with quotes like that, it's luring a lot of people into the industry, looking at it from an equity perspective. But if you can't answer that question, you have to be careful, because with so much capital going into the market, how do you know that your fund manager or the private credit that you're invested in isn't taking a higher level of risk? Okay? And remember, a lot of private credit is not regulated. So let's say a bank will only do a 70% loan against a construction deal. And if there's a lot of pressure in private credit, private lenders could end up doing 100% value on construction loans. Okay? Now, is that good? No, but whose responsibility is that? It's for the investor to really understand, one, are they getting a good return? And if it's appropriately risked for that particular opportunity. So buyer beware.
So ASIC has shone a light on risk disclosure in private credit. What are the red flags that people should be watching out for?
Well, it's exactly that whole point, is that private credit might be taking a lot more risk and investors don't understand. So the only issues that you're going to have, and especially when you're dealing with retail clients, is they don't understand the risk that they're taking with a private credit. And the private credit is not providing enough information or transparency to the investors to make an informed decision. So that really is one of the biggest fundamental issues that you have. And look, there's other parts of the recommendation from ASIC that were quite interesting as well. One of the real interesting concerns was from the regulator was, say, majority, which is up 50 to 60% of private credit exposure, is in speculative, high-risk construction loans. So, as I said to you before, it's not regulated, so that is a big concern. And do investors understand the risk they're taking?
So with the RBA cutting rates and demand for non-bank lending on the rise, where are you currently seeing the most attractive lending opportunities?
Well, the way that Msquared is positioned is that money never goes out of fashion. There's always a demand for it. And so, with cutting interest rates, certain parts of the private credit market or property market might do more, there might be more demand, and some other parts of the private credit market might have increased or decreased risk. So we assess it all the time, and our jobs is always to find opportunities and where to best place ourselves as well.
Okay. Are there particular sectors or borrower types that you're leaning into?
Well, look, the short-term loans are fantastic for us. We believe that is our niche in the marketplace, that we believe that is the best risk and reward. Now, at the present moment, we are quite conservative in relation to construction, and we stay away from anything which is specialized, rural, anything that I believe that long-term could be a particular problem. My wife normally says that I can be a little bit negative, but I actually tell her that it's actually an occupational hazard being a private credit person for more than 30 years. We have to look at risk, and we probably take a more negative, pessimistic view than an optimistic view, because we're always thinking about the negative and downside.
So you've mentioned that not all deal flow is good deal flow. How do you decide when to say no, and what does quality look like to you in the current environment?
There's a couple of different elements that we look at. You've heard the saying that a leopard doesn't change its spots. So we look at the character of the people who come to us. We look at behavior. We look at, there has to be a good commercial benefit or reason for someone to borrow money through us. And then we look at the security. And because we are so well defined in relation to what we can't do, that falls into a very interesting bracket of what we can. And then if it does fall into that, then those are normally very good opportunities for Msquared and for our investors.
So dividend yields across the ASX have compressed, bonds are steady, cash rates are falling. So for income-focused investors, where does private credit fit into their portfolio?
Private credit shouldn't be 100% of anyone's portfolio as well. It's a part of their portfolio. So normally it's between 5 and 15 or 20%, depending on how you construct your portfolio as well. And sometimes it replaces certain other asset classes that enhances the rate as well. So that's what we normally see in relation to how people invest with private credit, and it complements it. It's non-correlated to other asset classes, which is really, really important. So for example, what does that really mean? So if the share market falls by 10%, your private credit portfolio should not change in value at all. So it's non-correlated, it shouldn't have any impact at all. And so by putting a non-correlated asset that has a good, healthy income, it complements your portfolio, provides better liquidity and a lot more certainty as well.
Mm-hmm. So finally, you've compared today's confidence to the myth of Icarus, that danger often comes to things that seem safest.
Yes.
What risks are front of mind for you, and where do you see the greatest opportunities over the next 12 to 18 months?
So once again, I'm always looking on a downside, not the upside. And look, nothing is forever. I get quite nervous when people say property will never fall, the stock market will never fall because we've got too much liquidity. These things concern me because I've gone through the cycle a number of times. I've seen the cycle, worked through it, I've built businesses in these cycles. History doesn't repeat itself, it rhymes. That's one of my favorite sayings. So I live by that strategy, and you always have to think what will happen if there's a black swan event. And if you do invest thinking that, you create a portfolio that should be resilient to those type of events. And if you have lived through the GFC, you know that, that eventually it gets better, but at that particular point of time, it's very nerve-wracking. However, when you look at private credit, because it's in infancy, the value of private credit, the returns that you get, is not necessarily related to the risk. So if one fund manager pays you 8%, another one pays you 10%, it doesn't mean the risk is identical. It doesn't mean that the one that it's 10 is higher. It could be lower. So it's up to the investor to actually find those niches in the marketplace. And because we don't have that price discovery mechanism like we have in the share market, it's up to the investor to actually do the research, understand, and do their own comparison. And I think there is a lot of opportunities and gems in the marketplace.
Okay, great.
Thank you.
Thanks, Paul, for sitting down with Livewire today and sharing your insights.
Thank you so much.
If you enjoyed that interview, give it a like and don't forget to subscribe to our YouTube channel. We release new content every week.